Hello and welcome to Portfolio Matters Share Talk. One of the first companies we covered back on the 3rd of March was Rambler Metals and Mining, which we were very positive on and which has had a roller coaster ride in the last 3.5 months. And it has today announced an operations and financing update, which we are going to go through. But before we do that, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Over to you, Keith.
Thank you, Richard. Okay. We covered Rambler Metals and Mining back on the 3rd of March, and since then it's been a roller coaster ride. The shares got some brief traction in which they shot up to over 60p, and I, for one, added to my position on the way up and bought some actually at the top, which makes me look rather silly when the share price subsequently drifted strongly downwards after an update from the company talked about the need for further financing, which the market took badly. So today we have had an RNS detailing the financings and giving an operational update. So they've announced a package worth up to 50 million. Now that is quite misleading because a big chunk of it, the 30 million unsecured subordinated convertible loan, they're actually only plan to take 2 million of that. And the remaining 28 million, they will retain as a contingency funding, and they don't intend to draw it down. But anyway, going through this, they have a 3-year, 20 million senior secured notes, and they will use 6.6 million of that to retire the existing senior loan and other debts. They've got the 30 million unsecured subordinated convertible notes, which we've just talked about. And the previous loan was 5 million from West Face, and it is going to cost them money to retire that loan. So the bottom line is that the new money, the new 20 million Nugent money, will provide around 12.8 million of new money to Rambler. So there's a 3% arrangement fee, which takes the 20 million down to 19.4. Then they're repaying current debts of 6.6. So they get net about 12.8 million. And they are saying that is enough currently. And they will retain this 28 million contingency facility with the convertible notes. However, all that is subject to due diligence, etc. So on current plans, there would be a 15.4 million increase in debt. So that's 20 million senior notes plus the 2 million subordinated convertible notes that they're actually drawing down, and they're retiring 6.6. Okay, so going through the senior loan notes, these are very expensive, bearing in mind that the LIBOR is, pretty much near zero. So both interest rates and the yield premium required risky companies is currently very low. As we go through this, you'll see that it's costing them around 12% per annum. So this is 20 million 3-year senior secured loan note with New Gen Resource lending, LIBOR plus 8%. They've also issued 1.5 million warrants at approximately 40p. And there's a 3% arrangement fee. And they also have to give them 300 ounces of gold over the next 3 years. That's about 540k. Now, if we calculate all that, including fees, warrants, the gold royalty, I calculate the interest rate on the 3-year loan to be about 11.3%. But in addition to that, and we'll also go through this, there are fees attached to retiring the existing senior loan early, and those are also substantial. Now, on the unsecured subordinated convertible note, it's 30 million signed with Riverfort Global Opportunities. They're taking 2 million initially, and then a further 4 million would become available before the end of this year. This is all subject to due diligence. The remaining funds can only be drawn down with Riverfort consent. Each payment is subject to a 4% fee plus a 1.5% arrangement fee to SP Angel. The notes can then be converted to equity at the share price prior to the loan payment plus 40%, or the average of the 5 lowest daily VWAPs in the 20-day prior to the conversion notice, whichever of those two is the lower.
Diluting. What is a VWAP, Keith?
Value weighted average price. So it's the average price, basically. Good question, Richard. So this is good and bad news. I mean, clearly there's further dilution, but it's much, much less dilutive than the share placing or a rights issue. So I think this is good news and takes away all the uncertainty surrounding the financing. They now have enough finance to execute their plans. Now, the company can repay any of the advances and cancel the notes as long as the share price is lower than the conversion price. And if you're interested in this, there are various sub-clauses that detail this, and those are in the RNS. And as I've said, Rambler intend only to draw down the initial 2 million and keep the remaining 28 as contingency reserve. Okay, so they're also going to retire the existing West Face loan, now, which has a face value of 5 million. There's a 5% fee attached, and they state elsewhere that the total debt they're going to repay is 6.6. Now, there are fees attached to the repayment. So there's a 5% fee, that's 250 grand. In addition, Rambler has agreed to adjust the exercise price of the 8 million warrants they have given to West Face down from 20p to 14p. So I realize that 6p adjustment in the warrant price is not paid by the company. In essence, it's diluted value of shareholders. But if we include that as a fee, that equates to a further 640 grand's worth US dollars in fees. And if you add that to the costs over 3 years, that raises the price of the senior loan notes to 12.8%. So these senior loan notes are expensive. Yeah. Okay, and then we get on to the operational updates. So the new funds will be used to further develop Block 6 of the lower footwall zone, which will support production throughout 2021 and 2022. And the aim remains to fully utilize the current mill at its capacity of 1,350 tons a day at around 2% copper grade by the end of 2021. Okay, so that remains the target, which is good news. Now, we know that there was a stope collapse in April and May. And in addition to that, the stope, although they've rectified the problems, that stope has subsequently been disappointing. So the grades there have been below expectation, is my understanding. And so they have had to redesign the mine exploitation plan to avoid anything similar happening again in the future. Bad news, to my mind, is that they have also shelved the Duck Pond Mill purchase, which we talked about extensively in our original share talk, for the foreseeable future. So if you remember, the Duck Pond Mill equipment they'd bought for, I believe, 900K, and their plan was in 2025 onwards to relocate it to the Ming mine and substantially raise production. They have now shelved that in order to retain cash, but they state that they will be ongoing reviews of whether to establish processing facilities at the Ming mine site. The ore sorter, they're now talking about commencing construction of that in H2 2022. So next year, second half next year, and I am assuming that it will be in operation in 2023. So it'll have no impact in 2022. Again, I think that is a delay. I think previously we're expecting it to be in operation during 2022. It's now start of 2023. Now, good news is they've completed the diamond drilling program and are awaiting assay results. They say visually things look good, but we'll wait for the results. Okay, mine operational and planning update. Now, we know from previous RNSs that they have had unsolicited offers of interest in some of their other assets. And so they have commissioned resource estimates for the Little Deer and Whalesback deposits with the aim of unlocking their value. Further details are in the RNS. They also have engaged Deloitte to provide enterprise resource planning system, which is due to be implemented this year, which is good. So they'll have hopefully better operational control of the mine. In addition, and this is big news, they hope to have 6 to 7 stopes in operation by the end of this year, compared to just one at the start of this year. And given that one of the stopes they were developing collapsed, that gives them much better flexibility and hopefully will mean that their plans, their development plans, are much more robust to any failure of any one stope. And 80% of 2022 production will have been fully developed by the end of this year. Okay, so reminder, what is a stope? Well, a stope is essentially a void, an underground void where you have mined the rock. And a stope can be this large cutout section. So here, this is a stope, but also it can be any underground section where essentially you have mined out the ore and left an open space. So it's an area of the mine which you are underground mine that you are mining, basically. Okay, let's go through the guidance. Well, they don't state it, but they have substantially downgraded this year's forecasts. So if we go back to our presentation on the 3rd of March, we then had their numbers at 6,600 to 7,400 tons of copper in 2021. That was their guidance. They're now saying, and this is their mid number, 5,250. So that is, frankly, a big downgrade. That's a 20% cut. Their gold number has not changed. And they're also actually saying they now have some silver, which they weren't saying before, but as we'll say, that is tiny. But what you'll notice is they're expecting production in 2022 to be essentially double, the copper production to be double in 2022 compared to 21. So there continues to be upside here. Now, these are our March numbers, okay? And you will see that we were then expecting revenue in the lowercase of 57 million and in the uppercase of 65. And these were our original numbers for 2021, we were expecting break even, or uppercase, actually a decent profit. Now, let's go through the revised numbers. Now, given what we know about metals prices, I have actually upgraded the assumed metal prices we're going to use. So, in the case of copper, I'm assuming $4.2 a pound. We're halfway through the year. That's about the price now. Gold, about 1,800, which I think is around the average of the year so far. Same for silver, which is I put in at 26.5. And using their stated guidance numbers, and they provide a range, but that is their calculation, and that's the number in the RNS, and is about mid-range, then we get to revenue of 48 million. So although metals prices have gone up, that is a substantial reduction from our earlier assumptions of 57. Then moving on to next year, and again using their numbers, we talk about 91 million. So again, substantially down on our previous assumptions. So working all those new numbers through and using the production costs and depreciation costs in our previous estimates. So if we look at the revised numbers, sadly, the 2020 forecast now put us into substantial loss of around $7.1 million for 2021 before interest and tax. And then next year, this still looks good. You're talking about P ratio 1.7. And then in 2023, when the ore sorter comes in, these shares start to look really cheap. And that is based on the current share price of about 31p. So these remain good value. And moving on to positives. Okay. One of the big causes of uncertainty was uncertainty about the finances. I think the way the company handled the announcement that it was searching for more financing was poor. Just stating that they were searching for more financing without providing any details, shareholders could be forgiven for assuming the worst of a placing or a dilutive rights issue, both of which thankfully have not occurred. So they're now well funded. They have a clear mining plan and they've provided some good details on that. And I like the fact there are going to be 6 to 7 stopes as opposed to just one early in the year. They've got an ERP system from Deloitte being commissioned by the end of the year, all of which just adds to the impression that they are getting this business under control. And as we've just seen, based on the numbers they have provided and the assumptions we have made about production costs, the shares remain good value if they can execute their plans. But moving on to the negatives. So the stope collapse has not been featured in an RNS to my knowledge. It is announced in a Q&A on the website, and I found out a bit about it via the bulletin board, which is not very satisfactory, frankly. And the fact that that stope has proved disappointing shows the previous mine plan was flawed. They have just downgraded yet again production guidance for 21 and 22. And the financing, as we have seen, has been expensive. But importantly, it's been done. The ore sorter implementation is now pushed back to H2 2022, and that is the commencement of construction. So actually, I don't expect it to have any impact until 2023. And one of the main scenarios for upside from Rambler Metals was provided by the Duck Pond Mill, as we discussed in our original share talk, and that purchase has now been halted. So that removes potentially quite a lot of upside, albeit speculative upside. Hopefully, once they've got the financing and they have delivered on their production plans for the Ming mine, they will reconsider options for processing ore at the site. You'll remember they're currently trucking all the ore 40 kilometers to have it processed by a third party. Okay, so, well, what did I get wrong? We got quite a lot wrong, frankly, in that essentially the shares have been disappointing. I personally bought more as the share price went up, and I know a lot of our Discord members did as well. And I would absolutely retain all the shares that I bought, though I know Richard has wisely trimmed his at higher prices. So the big mistake I made was I believed that the cycle of downgrades has been broken, that the new management would come in, draw a line under everything, and would be actually conservative about their forward guidance. And in that, I was entirely wrong. We've done this, today's RNS essentially has downgraded their previous guidance by about 20%, which is substantial. Key takeaway for me from that is that what I failed to appreciate was that they needed more financing, which was again an assumption. We, based on the RNSs and the placing, the assumption was that the new money would allow them to execute their plans. And I feel they were optimistic because they needed to show a brave face to the market so that they could secure further funding. And when faced with a similar situation again, although I thought I was being conservative when I did our original share talk, it's clear I should have actually discounted their guidance by, a factor rather than taking the lower end. And in future, when faced with a turnaround situation like this again, I would do that. In conclusion, finances are sorted for now, but we haven't had an admission of yet more problems. And frankly, this company, since if you look back at the history of the last 10 years, it has been nothing but problems. And the bottom line is, in order for the share price to make any sustained progress, they have to get ahead of that cycle. They have to start over-delivering rather than under-delivering. And right now, that cycle remains in place, sadly. So if they can develop their plans according to guidance, the shares remain good value. And with a 2023 guidance giving us a P ratio as just over 1, there is very substantial upside here. But they have to start delivering the plans rather than missing them. Richard, your thoughts?
Yeah, thanks, Keith. You put a lot of hard work into that very quickly this morning, so well done. A very interesting summary. I think that I should say first of all that I bought some more this morning. So I have increased my position on the basis of this, and the reason I have is I believe that they have a relatively new chief executive, haven't they?
Yes.
He has clearly, and I hope appropriately, gone through the business plan and taken a red pen to certain items in the business plan. And his strategy would seem to be raise funding for a suitable period of time. And it's interesting that the debt is actually convertible, so that they won't hit a cliff of repayment. Raise funding to provide them sufficient cash to be able to do proper resource estimates to demonstrate what the value of the business is, and don't waste money on, for example, buying a second-hand mill and bringing it in, which personally I always thought was a slightly dubious thing to do, because buying a second-hand anything, which is a huge chunky piece of equipment, could potentially be fraught with difficulties because you don't really know if it's going to work until you've assembled it. And I think the fact that they're doing this diamond drilling program to try and more clearly define what their resources are, the fact that they have fixed the financing, albeit expensive, you have to look at what the payback is on that financing, which would be enormous if the resource is proven to be as large as we think it is. So, and obviously they've had some problems, haven't they, with the collapse of the stope or the flooding was it the Rambler who had the flooding?
Yes.
Earlier, they've obviously had some mine management problems, and maybe the ERP system will help to manage that side of things better as well. So I am positive on the basis that they are starting to put together what appears to be a sensible funding plan for the business. And also, I think the fact that the chief executive is changing the business plan is actually, in a way that makes sense, is not necessarily a bad sign. It's a sign that they are open to reviewing what they're doing and open to understanding where they may have got it wrong.
Okay, well, in which case we are both along for this journey. Let's hope that they actually start to deliver.
I was going to say, Keith, thank you very much for, as I said, for all your hard work in putting this together. It's been a great summary, so well done.
Yeah, thank you, Richard. Richard is on his boat. Thank you to everyone for watching. Please can you press like and subscribe to our channel, and it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.